Well, I say buying stock is a stock is a part ownership in a real business. And the 5 clues that I use to help guide me toward the better businesses, the really good businesses, are as follows. The first one, the very first thing I always look at, and this is just a habit that developed over several years, I wanted to know if they generated lots and lots of free cash flow. Because the value of a business is based on all the excess cash you're ever going to take out of it for as long as you own the business, and really for as long as the business exists. So I thought, well, if that's what the value is based on, then you better darn well focus on businesses that generate plenty of it. And that's free cash flow is after taxes, all expenses, all reinvestment necessary to maintain and grow the business. What the real cash profit that you're left over with is free cash flow. And I like businesses that gush free cash flow. That's number one. Number two is margins. And I like businesses with consistent margins. In capitalism, it's competitive. And the tendency over time is for competition to winnow those profit margins down and, sometimes to zero or less. So when you find a business that can maintain the same profit margin over a long period of time, and it's the consistency, not the thickness, like just at Costco, it's like a consistent 12-ish, 13-ish% gross margin, a consistent maybe 1.5%, 2%-ish net margin, just year after year after year, on average over time. And I think that consistency shows that they're doing something that repeatedly satisfies some desire in the marketplace, something that the marketplace just feels like it can't quite get somewhere else. Or even if it can get some of it somewhere else, it wants enough of it from this business that those margins can be maintained consistently. The third one is just a good balance sheet. And this is just like common sense, right? I mean, how would you feel if you had like $1 million in debt and $10,000 in the bank? You wouldn't feel great. and your prospects, you wouldn't be like financially safe at that point, right? You'd always have this thing looming over you. Well, what if you had $1 million in cash and $10,000 worth of debt? You wouldn't care about the debt. It would be meaningless because you could knock it out anytime you wanted, right? So that's one kind of great balance sheet. A company has a lot more cash than debt. Another kind is a business that, I mentioned Costco a moment ago, something that just earns money so consistently, they're just cranking the cash flow out day after day, week after week, year after year, decade after decade in some cases, in many cases that we look at in extreme value, that, they cover the cost of their debt like, 5, 6, 10, I've seen 20, 50 times over some companies. So carrying the debt is like, maybe they don't actually have more cash on the balance sheet than debt. Maybe they have more debt, but it's because servicing the debt is easy for them, right? So great balance sheet. Gushing free cash flow, consistent margins, great balance sheet. The fourth one I call shareholder rewards, and I've changed my tune on this over the years. Shareholder rewards are share repurchases and dividends. And mostly I thought, well, research shows that equity investors over the long term get like 40% or more of their returns from dividends. So, you'd better think about companies with a good dividend policy. But then, Warren Buffett comes along and teaches us all that, hey, the best thing you could do is find a company that can just reinvest at a high rate of return on their money and not have to pay it out in dividends. So that has actually led me to this idea that companies that pay out dividends are exercising some capital discipline. They're saying, something, we can only reinvest so much in our business. Warren Buffett has 100 businesses he can reinvest in, so he can keep money around. Plus, he's got reinsurance liabilities to worry about, so he's got to keep lots of cash around. But other companies, they only do 1 or 2 businesses. So they can't, the business grows and grows, and then they can only grow it so much. They can only reinvest so much, so they start paying it out in dividends regularly or repurchasing shares. And I think it shows capital discipline, really. You don't want, corporate managers are human beings. The money just burns a hole in their pocket the same way it does you and me and everybody else, right? Big sums of cash burn holes in your pockets. As soon as you get a big sum of cash, you know, you're like, oh, whoa, boy, I could buy this, I could buy that. Corporate managers are the same way. So you like it when they kind of keep the balance sheet, not too bloated with cash and pay out those dividends. So they're reinvesting enough in the business, and the balance sheet is in a good, safe place, like we said, clue number 3. But, they're paying out some of this cash to, just to get rid of it, really. It's discipline. It's a good thing. And finally, return on equity. Return on equity, if a business were a bank account, return on equity is just the interest rate you'd earn on all the money you left in it, right? So, and you'll hear like Munger and Buffett, Charlie Munger and Warren Buffett talk about, returns on capital, returns on equity, whatever. And they'll tell you that over time, over the long term, your returns are going to kind of converge to that number, even if you paid up a little bit for the stock, right? Because the business, as long as it has its competitive advantage and can maintain what it's doing, they're always going to be able to get a nice high return. A good business, right? The ones that get nice, consistently high returns, like 20% and above on the capital they reinvest. So that's it. Gushing free cash flow, consistent margins, good balance sheet, shareholder reward policy that makes sense, and consistent high return on equity. Those are our 5 financial clues that we use.